Hey everyone, welcome to our DAT IQ weekly market update. This is our update for Tuesday, February 23rd, 2021. I'm Ken Adamo, Chief of Analytics at DAT, and we have a full house this week, joined by Dean Croke, who's our Principal Industry Analyst, Ned Damon, Principal Data Scientist, and Chris Kaplis, Chief Scientist. Welcome, guys.
Howdy. Welcome. Can I object to the term full house being used for four people? Because it's three of a kind in a pair. So I feel like you can only use full house to describe a group of five people.
Is that, I mean, how many people were in the show Full House?
I think four.
That's a good point.
Yeah, well, maybe you should do a data science study around that, Ned.
Do some research.
Yeah, do a little PDA, an EDA on that, exploratory data analysis. All right, so we have a packed agenda this week. We're lucky enough to be joined by Chris, who's revitalized, fresh off the slopes, ready to talk some freight. We're here every Tuesday talking about freight markets, trends that we're seeing, and answering your questions. So if you have any questions, please feel free to drop them in the chat below. Like I mentioned last week, we tend to get them all at the end, which makes it really hard for us to get to all of them. So don't be bashful. Don't be shy. Go ahead, drop your question, comment in there. We get questions all the time. Business Insider actually reached out for some questions for Dean earlier this week. He was able to help out with some insight on the freight markets. So please don't be bashful. So with that, I'm going to jump right into our key trends of the week. For that, I have to look at this screen, so I apologize. I think the big story, right, the storms that hit last week, major disruption through freight networks, record financial and human loss in Texas. Our hearts go out to everyone down there dealing with the ramifications of that. As a result, we're seeing an impact on van and reefer rates for sure. Capacity tightening. I think you'll see some of these load-to-truck ratio charts are remarkable, reaching sort of short-term acute all-time highs. And then some more winter weather this week. Luckily, I was watching some weather news. It looks like some warmth is returning to Texas, which is, I'm sure, welcome. Someone did point out, for those in Texas, don't trust puddles on the road. Us Midwesterners will tell you that there is an awfully deep pothole lurking under that puddle. Your tires and rims will thank you if you're not used to driving in winter-stricken weather. So with that, I'll turn it over to Dean to walk us through our market update. Dean?
Yeah, thanks, Ken. One of the things we studied last week was the polar vortex event from back in 2014 was the last significant one we had. And the sort of comparing and contrasting them, both are very different events because of duration and location. But it took over 100 days for spot rates to move up 18 cents a mile in 2014. This time, we saw spot rates move up by about the same amount in just 7 days, to give you an idea of how acute the impact was on spot markets last week. So let's jump right into some of that activity. In the dry van space, load board activity was off the charts, as you can see there. Load post volume surged by 39% on the back of the severe weather disruptions. Capacity tightened considerably with 17% fewer trucks last week. This drove up the load-to-truck ratio up to 9.58. For the dry van. In the refrigerated sector, there was a similar effect. Cold temps obviously played a large role in driving demand for reefers for that traditional dry van freight to keep it from freezing. So demand was higher. Load posts increased by exactly the same amount as dry van. Capacity tightened also. Load-to-truck ratio was up to 21.21. It had the biggest movement of the three equipment types due to the extreme cold. In flatbed, and in contrast to dry van and reefer, flatbed volumes actually dropped last week by about 4%. But with 15% fewer trucks posting for loads due to the extreme weather and so many road closures, last week's flatbed load-to-truck ratio increased to 63.63. So lots of activity on the market condition index this week. In the top 10 markets, where about a quarter of our volume comes from, volumes increased 26%, capacity tightened, spot rates moved up 16 cents a mile on average across those top 10 markets. One of the things we focused on last week was the West Coast. The 72-hour shutdown by Union Pacific resulted in dry van load posts in the Los Angeles, Ontario, San Francisco, Stockton, and Seattle markets, where UP is dominant. Those load volumes jumped 31% week over week. And that's interesting because a lot of that volume moved over to truckload from intermodal, where those markets in particular had been on the downslope for 3 weeks prior. Volumes jumped last week and spot rates moved up about 7 cents a mile. In the two largest markets, Los Angeles and Ontario, load posts were up close to 46% and rates up 15 cents a mile. A lot of the focus was on Dallas last week. It was hardest hit, of course, from a freight market perspective, being one of the largest. Inbound volumes increased to 54% week over week, while outbound volumes dropped 6% week over week. Same story played out in most markets impacted by the cold. Inbound volumes were up from non-affected areas and outbound volumes plummeted as the week dragged on. In the refrigerated market, load post volumes increased by 27% week over week and spot rates were up 20 cents a mile on average for the top 10 markets. Elizabeth was the number one market. Capacity was particularly tight as the storms moved sort of northeast. Rates were up 30 cents a mile to 248 out of Elizabeth. Similar story in Chicago and Joliet. Capacity tightened. Rates are up by about 12 cents a mile there. And one of the hard-hit areas in the Rio Grande Valley, where snow has decimated the citrus and leafy green crops, volumes were up early in the week, 74% week over week. Rates are up to 277 a mile. That was a 40 cents a mile jump as growers tried to move as much of the crop out of the way of the cold as they could. Moving over to flatbed, load posts were only up 5% week over week in the top 10 markets, even though they were down in all markets. Capacity tightened in those top 10 markets. Rates moved up 20 cents a mile to an average of $3.12 per mile for all outbound loads in the top 10 markets. In St. Louis, where temperatures dropped to 0 last week, outbound volumes dropped by 1%, but capacity tightened, rapidly driving up spot rates by close to 60 cents a mile to an average of $3.52. So wrapping up this week's update with a quick look at the year-over-year spot rates. As you can see on the chart, we've had a U-shaped effect on spot rates this week. Capacity tightened rapidly. Major interstates were reduced to a crawl. Trucks stopped. Truck stops couldn't pump diesel. Truckers who were not prepared, in particular, talking to a lot of them, they had their fuel filters ice up, diesel gel, batteries failed. And when you get cold weather like this, things start breaking, and that just slowed the entire capacity chain down. Other than the freezing cold, snow covered 70% of the US, so that added to the slowdown on the truckload side. The net effect was that dry van spot rates increased by 8%, or about 19 cents a mile to $2.24 last week. In the refrigerated sector, spot rates reacted much the same as dry van. They increased by 22 cents a mile to $2.54 a mile, excluding fuel. Reefer spot rates are now about 29% higher, or 73 cents a mile, than the same week last year. They're also back at the same level as they were at the peak around Thanksgiving last year. And lastly, in flatbed, much tighter capacity pushed flatbed spot rates up about 7 cents a mile to $2.29 last week. Compared to this week in 2020, flatbed rates are about 43 cents a mile higher. So that's it for this week's market update. If you want to find out more, go to dat.com/market update, where we break down all of this information in much more detail. So over to you, Ned, for the forecast.
Thank you, Dean. So we're going to be going through the short-term forecast first, and then we'll see where we go from there. I'm going to put a pin in this because I have done some research during this break, and I will be defending my honor on the field of pop culture trivia. So we're going to be beginning with the van short-term forecast or short to mid-term forecast. You can see in blue the market rate observed by DAT. In green, that chart, I think, is actually color-coded opposite of how it should be. So that chart is, in fact, color-coded opposite of how it should be. The ratecast model is in red, unlike the legend, whereas the short-term model is in green. That legend is wrong. And then we have a pair of blended forecasts, one in gold and one in gray, that are showing mixtures of these two models in different amounts and in different ways. And you can see Ratecast is expecting things to level off a little bit, whereas the short-term model is expecting the short-term trend to continue going forward, up, up, up. Of these two, I feel like the Ratecast model is a fair bit, the red line is a fair bit more believable, but I think that we will see as we go forward. Moving on to the next, and this is totally my fault for not doing a thorough vetting of these charts. before the show. Moving on to the next chart, the reefer. Again, we can see the rate, the market rate observed by DAT in blue for the actuals. We can see the short-term model in, goodness me, the short-term model in green again, I believe, and the ratecast model in red. And you can see that the short-term model is expecting the trend to continue forward with a little bit of downward pressure, so it's not a pure up and to the right, whereas the ratecast model is expecting a little bit of a jump, and then from there, continuing forward in a straight path, more or less leveling out at about $2.50. Finally, for flatbed, we have a similar story with the market rate observed by DAT in blue, the ratecast model in red, which is projecting a little bit up and then kind of a little bit of a bump continued upwards, while the short-term model is projecting just pure up and to the right, and the blended forecasts in gold and gray are mixtures of those two in different amounts and in different ways. That is it for the short-term forecast for this week. All right, now for the more important thing of defending my pop culture honor. In Full House, there are the 2 goofy friends and the 3 daughters. So the main character has a pair, his goofy friends, and then his 3 daughters at the beginning of the show, for a total of 5, a pair and 3 of a kind, as the poker hand. I'm done.
I see. Thank you, Ned. I'm not sure what was more insightful, the pop culture commentary or the forecasts. So again, before we get to our Ask IQ question of the week, I'm just putting a call out there for questions from our listeners. Please make sure you drop them in the chat below. And we'll, especially if you have any shipper-focused questions or procurement, we have Chris on this week, our resident expert on the shipper side of the equation. Who I think will be more than happy to share some sage wisdom and advice as it pertains to shippers. So Ned, do you want to hit us with the question for the week?
Absolutely. This week's DAT question of the week is, how long can we expect to see the impact of this cold weather?
I'm going to guess until it warms up. my gut shot, old prediction. But I think the root of the question is the impacts that the cold weather had on the freight markets. And for that, I think Dean and Chris maybe are the best two to answer that question.
Yeah, it's been pretty acute. I mean, I was watching the Weather Channel this morning, and the swing in ambient temperatures has been something like 70 degrees over the course of 7 days. The challenge they now got is flooding. And that's a huge problem that we deal with here in the Northeast in particular, when you have record level snowfalls and then everything melts and then you've got blocked drains that are frozen. So I think the impact will be felt through this week. But if I just look at this, the trucking supply side, a lot of the major interstates last week that run, basically in every direction, but anything east of the Mississippi was particularly backlogged. Trucks were at a crawl across the I-40, even down on the I-10 in Louisiana, which is really uncharacteristic. So that just brought everything to a standstill. I think it'll open up pretty quickly. The limiting factor, though, I think will be on infrastructure, particularly where power has been affected. They tend to clear roads pretty quickly, but the power outages have been so extreme that will have a bigger impact on people's ability to move around and buy things like fuel. Of course, the bigger impact will be on a lot of the refineries who have had issues trying to stay open. So I think the impact will be felt throughout this week, but trucks are moving again from a supply side.
I guess to kind of – oh, sorry, go ahead, Chris.
Nope, go ahead, Nick.
Oh, I guess to kind of take Ken's question more, or Ken's response a little bit more seriously, I think that what people are interested in asking is, obviously when things warm up, things will get better, but there's a question of, do we expect a long-term kind of shadow or echo beyond when the temperatures warm back up? And I think to Dean's point that there's likely to be this kind of shadow or echo because there's been damage to the infrastructure and to the kind of network of moving goods around beyond just trucks can't move right now. Sorry, Chris.
No, I was just going to say shippers have faced almost a triple whammy, right? Because it's still pandemic, and that's causing its own issues with limited workforce and things like that. Plus, they're playing catch up right now. If you're a manufacturer, you're still catching up from all the increased demand for durable goods for consumers, especially. And then with the cold weather, that just limits both your supply of your workforce and your demand has shot through the roof, especially if you're a retailer for essential goods. You've seen it's like we're back in March 2020 with empty store shelves all throughout Texas and other parts of the Southeast. So I don't think it's a long-term blip. I think overall we're seeing things recover at the end of Q1, beginning of Q2. This to me is a blip, but it's exacerbating all the other factors. The cold weather is more, we're used to it up here where Dean and I are up in New England. In Texas, they are not used to this. This is brand new weird stuff for them. I have family in Texas who've been living there for 40 years. They used their fireplace for the first time because they had to. They didn't know how to turn it on. So this is new worlds for them, and I think it's affecting both the workforce and the demand.
I guess sorry, go ahead, Ken.
I was going to say, if you think about 14, the 14 polar vortex came at a natural inflection point in the freight cycle.
Fair.
Which is different, right? So 14 kicked off the boom of, the freight cycle, the upcycle that was 14 and 15, that then turned into what we would call the industrial recession of late 15, all of 16, and early 17, which then pivoted with the tropical weather in mid 17 and turned, the ELD boom of that kind of gets us current. So this is kind of peculiar in a sense in that it's happening in kind of like a freight purgatory. I mean, it's just, even prior to the polar vortex, what was it? 2012 was Superstorm Sandy, was another sort of fence post that marked a downturn in the freight market, which lasted in 12 and 13.
Yeah, I remember 2014 being something happened for a long period of time in different places. It just kept happening all over. This seemed to be much shorter time period, right, Dean? I remember the polar vortex. Yep. It wasn't just like a 1 week thing. It just kept popping up and just messing everything up. This seemed a little more focused in time, if nothing else. That's why I don't think it's going to have long legs.
Yeah, I don't either.
The first storm in 2013-14 was in October. So it was a long season. The last one wasn't until May. And when we had that big Atlantic storm in late January, I think it was. So we had lots of different parts of the company were affected. What I noticed in spot rates was dry vans sort of went up about 18 cents a mile and then dropped off during that March quiet period that we typically see. Refrigerated rates, on the other hand, in 2014, not only went up as a result of the cold, they continued going all the way through to the 4th of July produce season peak. So it's conceivable that could happen. There's so many unknowns in the market right now, but think about capacity was already tight before this happened. And that's just exacerbated what appears to be quite a fragile network.
I mean, I know that we were talking about there being an overall more downside risk than upside risk going through the rest of the year. Is that still the case, or is the capacity blip here going to drag that out?
I'll take the first crack at that. I don't think the fact that so I'm not going to minimize what happened, right? But I don't think this acute issue is going to, I don't think we'll be talking about this in August. To me, the biggest thing happening now that we'll be talking about then is all of these Class 8 truck orders. That's my sort of perspective on the market.
Mm-hmm.
That's the biggest thing happening in freight right now.
I think we're going to talk about how the excess of vaccines are going to change things, because that's going to change, question, when do we open up as a country? Do we open up in April, which some people are saying? Is it going to be June, or is it going to be October? Because that's going to spur a lot of other sales and demand for other products that have been kind of suppressed for right now. So I'm betting on vaccines as being the thing we still talk about in 4 to 6 months from now.
Hey, Chris, a lot of activity, a lot of talk this morning in particular in the media about the bullwhip effect. So, in April last year, we were talking about the bullwhip effect in terms of what the likely outcome would be on this sort of amplification of demand through different parts of the supply chain. Now the talk is about the bullwhip effect creating an excess of inventory. And I just wonder, is from a shipper side, is that something that you're seeing as a major concern for our customers, as in we get through this demand period, services start to increase, and we end up with too many bikes, too many outdoor furniture settings? Is that a possibility?
It could be. So for anyone who doesn't know what the bullwhip demand is, or the bullwhip effect rather, is as you move further away from consumers back upstream to manufacturers, then any change or amplification gets magnified, and it oscillates at higher amplitudes. So if there's a little blip in demand on consumer, the supplier of the supplier of the supplier feels this dramatically, and what it can lead to is big swings in over demand and oversupply and back and forth. I think right now the manufacturers are facing shortages for things they hadn't expected. Anyone who's tried to buy certain things, you just can't buy them, not because they don't want to sell them, is that there's usually some component they don't have. I was trying to buy a roof rack for skis, and you can't do it. And I talked to the manufacturer, it's because they don't have the sealant to finish it off. And so the supply chains for these products are so complex that you have to have everything. You can't have 70% of the bill of materials. And so that's what's causing an effect. And I think, Dean, you're exactly right. I think we're going to see a glut of things coming in about 6 months, because like everyone does, they see all this pandemic demand. And the question is, will that pandemic demand be there post-pandemic? Will the prepared foods be there? Will people still want Pelotons when they can go out biking or go outside? That's the open question. But I think we will see a glut in some of that. I don't think the pandemic demand for all these products will stay post-pandemic. I think it'll settle out and there will be a glut.
All right, Ned, do you want to walk us through? We got a bunch of questions piling up here, and I asked for them, so I want to make sure we get to them.
All right, a question from Kenyon. How are we able to access the forecast online?
So the easiest answer on a lane level would be to purchase Ratecast, and we actually now have in beta, which I'll talk a little bit more about this at the end. Remind me, someone, if I forget. It's available as a beta through your standard multi-lane download process. When you go into Rate View and you batch upload a file and download, you can check a box. It's no added cost. You check a box, and you'll get 12-month summary of the spot market Ratecast through your product. If you want just what we're showing here, I believe Dean posts snapshots of the images in his weekly market update, right, Dean?
Correct.
So that's the way to get kind of this high-level macro graph view of Ratecast.
David asks, how long are you expecting the market to rise?
It's a loaded question, right?
Yeah.
Who wants to take a first crack at that?
I'll jump in. What the heck? Okay. I've been wrong. Then, Dean, you can correct anything I say. I think we're going to see a blip for this, probably for this month, recovering from the weather and those short-term impacts. But I see rates settling down nationally, mainly dry van, starting at the beginning, end of March, end of Q1, beginning of Q2. That's my sense. Dean?
Yeah, I was looking at a little bit more short-term. If you think about the week before last week when the polar vortex really took effect, we had a week of cold weather in the Midwest and plains that tightened capacity, and spot rates moved up about 5 cents a mile. Last week they moved up about 20 cents a mile in dry van. So I think there will be a blip, and I think they'll settle down pretty quickly once people start to catch up on that backlog. That's my sense.
Jeffrey asks, I'm curious as to what the mindset is regarding the contract tender rejection rates as we are going through the residual effects of the weather with produce season right around the corner.
Yeah, you can actually, the rejection rates, we've done a lot of studies of this at MIT, they are very closely correlated to spot usage, right? It makes sense because if you have rejections, you're going to eventually go to the spot. Not 100%, but they're very highly correlated. So we're seeing a much higher rate of rejection going deeper in the routing guides over the last couple of weeks. If you look at spot rates, you can see what's happening to the rejection rates. They're almost identical.
Yep. Stephen asks, are we really thinking the forecast that was provided this morning for reefer is accurate? 2 weeks ago, the forecast was showing between $2 and $2.25. Now the Ratecast model is showing between $2.50 and $2.60. He adds, I don't think the forecast is taking into account the weather blip and then is settling back to what it was prior to this. I think that's largely correct, is that it's not completely accounting for the weather being like this temporary blip, and it's assuming that there's some kind of more sustained forward trend. And I think that it will correct itself. But yeah.
Yeah, I think once it sees a few more days of normalcy, it'll start to correct back downwards. But I mean, it's a fair call out. The long-term forecast will be much less effective. So the longer-term forecast that you'd be using for RFPs going to be much less affected by this. In fact, it probably, since it's updated I know it's updated daily, but it's forecasting a new 52-week strip every Sunday.
Yes.
Right?
Yeah, that's correct.
Probably probably won't even see much of this. If one or two of the 52 weeks would probably be impacted, if at all.
Aaron asks, are there other factors besides the weather that are contributing to the short-term tightening of the spot market, specifically refrigerated outbound from Chicago?
I could maybe offer one solution. I've been watching this for a couple of weeks. I think the intermodal issue is coming into play here. There's a lot of capacity constraints and delays across intermodal networks that tend to hub in the Joliet market just south of Chicago. I tend to look at Joliet and Chicago together when I think about truckload capacity in that region because of the hubbing of all of the intermodal railroads for points further east. So I think that's playing into this, but to the extent I'm not sure. It's more anecdotal at this stage. We saw the same effect on the West Coast where spot market volumes accelerated last week when the 72-hour shutdown was announced. So that's a good example of, I think, how the intermodal networks have been struggling with the colder weather.
Just to add to what you said, Dean, I think that there's another important point, and that's refrigerated. And Ken, you brought this up the last time we talked about this. I really should be referred to as temperature controlled, because if you have goods that will spoil if it gets too cold, I know that temperatures are warming up, but to the extent that like you need things to be protected from the cold, that's going to call for a reefer.
Mm-hmm.
Yeah, the insulation's credible, and what they're able to do in the keep from freeze and controlled room temp, we've seen that for sure.
Ken, I've got an example. I was talking to a colleague of mine who was driving last week, and this is what we used in the Business Insider story. When I called him last Tuesday, he was under a load of Diet Coke, and the outside temperature was -10, and the set point on the load in terms of the bill of lading was +26. And to give you an idea how good the insulation is in the trailer, the van temperature never got below 29. So even though it had to be above 26 and it was -10 outside, the actual set point, the temperature on the reading never got below 29. So it's a good example of protect from freeze and how things like anything that's liquid in containers, in particular plastic bottles or aluminum cans, needs to be kept at a warmer temperature.
Anything else for that? We got a question from Adam. Warehouses all over are crammed up. Will this call for a better forecast for this year and next? I think that, just to speak from the forecasting side, we've got a lot of things in the pipeline that we're planning on incorporating into RateCast that's going to improve the forecast. It's a continuous process. It's a little slow, unfortunately, to be incorporating things because we have a lot of validation that we need to do because we're forecasting so many lanes. But, the version of RateCast that you see now is not going to hopefully be the same version of RateCast next year. It's going to have a lot more parts to the forecast, and I think that will continue to improve its accuracy going out.
I want to kick this one over to Chris because my supposition would be the reason you're seeing crammed up warehouses is folks gun shy of what happened last April, and they're wanting to overstock and ensure that they have products to deliver.
Yeah, I mean, right now demand is still peaking for certain things. It's still very unbalanced, right? I don't think people are buying pants right now still, right? We're still buying...
Not ones that require a belt.
Yeah.
Thank God. But I think you're exactly right, Ken. I think people are trying to avoid the total stock out that we saw. But there's a quote in, I think you saw it, Dean, today in the Wall Street Journal. A guy says, you can't just stop a supply chain and start it again without having hiccups. It's going to happen. There will be these glitches of things. So we should expect that throughout the spring.
I think we have time for one very final question. It's from Peter. What forecasting market resources that are similar to this one do you recommend? I think we would be remiss not to call out the FMIC forecasts.
Sure. Yeah, and the FMIC signal report comes out once a month. In fact, I'm putting it together today. It'll come out later this week. We send that out mainly to our own consortium members. But we tend to look at the more the contract moves, how those things go longer term, because this forecast is more for shippers for their long-term strategic buys. And so, like I said, we see this still cresting. I haven't finished the analysis here. We see things settling down, recovering from the pandemic at the end of Q1, beginning of Q2. But we'll see how that goes.
There are some other, if you're looking for things to add into your internal perspective on forecasting. I mean, there are other good data sources out there to give your modeling some color and some context. Freight specific, I'll throw out ATA's tonnage number, CAS's expenditure and volume number. Both are well respected and trusted. Jason Miller up at Michigan State's been doing some really interesting stuff around their truckload index. Kind of tangent factors, you can always loop in inventory numbers. A lot of this stuff is going to be free that I'm talking about now. You can just go to the St. Louis Fred and hit that with an API or pull it manually. You can do industrial production. You can do PMI, LMI, all of these different data sets that can kind of help give you a little bit of an edge in your forecasting. I will caution you though, right? So if you pull 5 data sources and one seems out, way out there, to borrow another thing from Jason Miller, it's the responsibility of the outlier to explain why they're the outlier. So if everything else is telling you volumes are up low to mid single digits and another source is telling you that volume's up 20, 30%, I think it's fair to question that data source.
To add one more thing, if you're looking at short-term forecasting, MCI does have a forecast element to it. So if you're relying on, short-term spot supply and demand indicators, I'd recommend MCI, especially on a inbound outbound level. Looking at the difference between those two can be really helpful.
Yeah, for sure. I mean, we like it so much we're putting it in our model. So I want to end on one thing. I put out a call if anyone follows DAT or me or anyone who's reshared it on LinkedIn. I kind of made an oopsie on Friday, and we're trying to stress test our a new feature on our RateCast, which is the multi-lane download thing I was talking about. So we put out a call for some RFPs. I was hoping I'd get a couple, right? Who really pays attention to LinkedIn on a Friday? So we were overwhelmed and inundated. It actually took me back to when I started as a pricing person, because I literally sat down and ground on RFPs, and my team actually jumped in and kind of did pricing all day on Friday, which was awesome. So first of all, thank you for that. It was more information. It gives us tremendous insight. But I also want to open it up. If you have any stragglers, maybe you didn't see my post. If you have anything interesting that maybe has you scratching your head and you want to send that along to us, askiq@dat.com is the best way to get it to us. Again, I can't tell you what a treasure trove of information it's been. I saw my first kind of real live mini bid in the real world. It was a 120-day rate hold from a shipper on, I think, like 270 some lanes. Just really interesting to see some of the trends with and without fuel, live load and unload versus drop and hook. So it really does help us make our products better when we interact more with you guys out there. So again, if you have anything interesting or you want to bump it up against our model, I want to extend that offer. Just understand that I wouldn't send us anything super time sensitive, because we're still clearing out a backlog from Friday that was self-inflicted by me. The only other thing I'll shout out, since Chris is here, we do it anyway, but since he's here especially, Freightvine podcast, really interesting conversations. Do you have anyone who's coming up here, Chris?
Actually, on Thursday, we'll have Kevin Zweier, who's the VP of Transportation at Chainalytics, who's run more transportation procurement bids than anyone in the world. So we'll be talking exactly what you just talked about, Ken. Mini bids, dynamic pricing, how's that changing? Will the things being done in the pandemic still go on after the pandemic? So it'll be an interesting conversation. That'll be released Thursday, the 20th.
Yeah, the one with Boyle was really cool. I recommend, if you're interested about vaccine and just sort of like that boutique specialty carrier thing, highly recommend checking that out. It was a really, really great piece. So with that, I want to thank everyone for joining. We'll be here next Tuesday at 10 a.m. Eastern. And with that, have a great rest of your week. Thanks.
Thanks, everyone.
Bye.
Good.